Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. U.S. Market Breakdown and Tech Outlook. This video presents a direct informational narration of the source document. Today, we're cutting through the market noise to break down the current U.S. tech and broader market outlook. Are we witnessing a healthy sector rotation, or is this the start of a broader structural sell-off? Let's dive right in.
We've got a lot of fascinating ground to cover in this explainer, from dissecting market breadth and the sheer chaos of end-of-month rebalancing to pinpointing precise technicals for the S&P, the NASDAQ, and the heavyweights across big tech and software.
Part 1, Market Breadth and Indices. Let's start by looking at a somewhat mixed but stable overarching view of the major indices.
On a daily basis, the S&P 500 and the Dow hovered nearly flat, while the Russell rose slightly. But behind that surface-level stability, the NASDAQ actually dropped 1%, and semiconductors took a massive hit. A brutal 5% daily drop pushed its weekly decline to 7.7%. Talk about whiplash, right? This completely erased the prior week's gains, leaving the sector essentially flatlined over a 2-week stretch.
Now, here's where the underlying divergence gets really fascinating. Look at the core market cap weighted S&P 500, down almost 2% on the week. But its equal weight counterpart, it was actually up over 0.5%. This is a classic mechanical mean reversion in action. The broader market is finally warming up, and we're seeing healthy breadth, with 324 advancing stocks compared to just 178 declining. Basically, we aren't just relying on semiconductors and memory stocks to single-handedly prop up the whole index anymore.
Within the megacaps, it was definitely a mixed bag. Microsoft confidently led the charge, up 5%, with Amazon gaining 2.5% and Meta following suit at 1.3%. Google, however, was kind of left out in the cold, absorbing a solitary 2% drop while its peers climbed higher.
Moving on to Part 2, End-of-Month Rebalancing Dynamics. The central question burning right now is whether this recent trading activity represents a true sector rotation or if it's just mechanical market chaos.
Well, because pension funds have seen their equity portfolios swell significantly during this recent rally, mechanical rules are actually forcing them into historically large passive sell-offs as the quarter ends. They literally have to sell to balance the books, and that translates directly into the chaotic mechanical volume spikes we're seeing flash across the board right now.
So, what's the bottom line here? You simply cannot accurately judge the true market direction based on these current volume spikes alone. You really have to wait for the dust to settle in the first week of July. Once capital is thoroughly reallocated, we'll finally be able to see if these are real, ongoing trends or just some heavy institutional house cleaning.
Part 3, S&P and NASDAQ Technicals. We are currently sitting at some incredibly critical support levels that we need to talk about. Recently, the S&P 500 narrowly avoided triggering commodity trading advisor sell programs by managing to hold just above the critical 73.12 level. Looking at the broader institutional data, the SPY is hovering right in its current support band of 72.7 to 74.3. The big picture? Forward earnings point to a massive long-term target between 6,500 and 8,000, but definitely watch the QQQ closely. If it breaks below that 693 to 72 zone, there's a steep staircase of deeper supports waiting to catch it at 665, 645, 637, and 617.
Part 4 brings us to the semiconductor sector analysis. Let's weigh the highly volatile chart technicals against the very real AI earnings that are actually driving them.
These are your absolute critical lines in the sand for the semiconductor ETFs. For the SOXX, support sits between 554 and 582. If it breaks definitively below 554, or if the SMH drops under its breakdown level of 557, that confirms a definitive market top for the sector. Keep a very close eye on these floors as we navigate the coming weeks.
But here's why a total collapse is highly unlikely: AI capital expenditure. Semiconductors still provide the core fundamental earnings support for the entire S&P 500. So even as some of these overheated valuations cool off, real AI CapEx is acting as a massive shock absorber, effectively buffering the broader market from an absolute collapse.
Moving on to Part 5, Big Tech Breakdown. Let's pinpoint the precise support and value zones for the megacaps.
Looking at these levels tells us a fascinating story.
Google is offering wide, long-term value zones between 279 and 349, with specific pockets at 298 to 308 and 311 to 325. Meanwhile, Amazon is leaning firmly on its current market price support in the 226 to 240 range. Microsoft is definitely the one to watch for the fastest free cash flow recovery, sitting in a support range of 392 to 435. And Meta? That becomes a really interesting deep value play as it approaches 500, which is getting very close to its cost basis.
Elsewhere in tech and EVs, NVIDIA's key support is firmly anchored at 175, with a deeper band at 150 to 160, calculated on a massive 20 to 30 times growth basis. AMD is holding strong sideways right at its highs. We also saw a flawless algorithmic support bounce for Tesla at 368, with deeper values sitting a bit lower at 345 to 350. And SpaceX? It's currently at 150, but volume is shrinking as it drifts back down toward its IPO price of 135.
Finally, Part 6, the software sector and Tesla outlook. We're really looking for signs of true sector stabilization here. Across the board, from Micron holding support between 1020 and 1085 to SanDisk at 1727 to 1809, these chip and software names have clearly defined floors. Intel has support pockets at 105 to 113 and 115 to 121.22, while Intu's support is at 244 to 257, facing resistance zones up to 420. Knowing these exact levels is absolutely crucial for your risk management. Oh, and it's also worth noting that Netflix needs a significant dip below 77 to trigger a strong structural buy signal. Looking at the broader software space, the IGV ETF recently hit a low of 84.2, suggesting it's approaching a major bottom. Corporate software earnings actually prove that AI isn't completely replacing legacy businesses just yet. The real issue is simply the slow integration and monetization of these new AI tools. Palantir is a great example of these dynamics. It rebounded nicely in the 100 to 118 range, but its deep long-term value remains much lower, down at the 80 to 97 level.
But not everyone is enjoying the rebound. Oracle really stands out for its specific stagnation, completely missing the broader software sector rally. This structural weakness is being driven by record-high credit default swaps and its heavy exposure to the delayed OpenAI IPO. That delay is significantly pushing back their timeline for returning capital.
As we head into a shortened trading week, the structural risks remain incredibly high. Mechanical sell-offs are ongoing, and as the data shows, major indices are sitting dangerously close to the edge of breakdown levels. Keep your psychological guard up and your risk strictly managed. The ultimate question is, when the dust from this institutional rebalancing finally settles in July, will we see a renewed tech rally or the start of a much deeper correction? We'd love to hear your thoughts, so let us know in the comments below, and we'll see you next time.